Welcome back. Well, as we wrap up the trading for this week, we see the S&P 500 shown in the blue line here, closing right in the middle of the range for the week. The red line represents the low of this week's trading range. The green line is the high. It looks like we made a little bit of upward progress, but certainly there has been also quite a bit of selling as well. Taking a look at the overall trend, the yellow dots represent the closing prices for the S&P 500. The red line represents the weekly lows and the blue weekly highs. So we've seen a nice steady trend to the downside, almost reaching the swing lows we saw going back to late December, 3850 to the 3800 levels. So maybe this support will act as a future support. It is important to note that the yellow dots congregating near the red line, near each day's respective weekly lows, is a bearish sign. If we see the S&P 500 start to close near the highs of the week, that could certainly be a sign of some sort of reversal, but so far we're not seeing that. The past couple days we've seen some strength, but it also seems like there's a lot of selling pressure out there. The red line here shows the S&P 500. The white histogram bars show us every Friday's close as a percentage of the week. It's really important to make a note of where the market closes each Friday. Now, 2 weeks ago, we closed near the high of, or almost exactly on the high of the week, and therefore we registered this 100% histogram bar. Last week we closed really at the lows, and it looks like right in the middle of the 50% area of the overall trend. So before this week, last week we saw a lot of selling. It looks like this week the market is closed in somewhat of a neutral stance. Every dot here represents one stock in the S&P 500 on its own respective RSI, relative strength index. Readings below 30 are considered oversold. Above 7, you're considered overbought. And then this dotted line in the middle represents a 50% level. Clearly, we can see the vast majority of the stocks are below 50%, and quite a few of them are below even the 30% level. That shows us really how weak the markets have been. The histogram bars here shows a count of how many stocks in the S&P 500 are found in every respective RSI bracket. So for example, we have 71 stocks with a relative strength of 25 to 30. We have another 73 stocks with an RSI of 30 to 35, and another 74 stocks with an RSI between 35 to 40. So right there, almost 50%, or around 50% of the S&P 500 has a relative strength between 25 to 40. That's a pretty weak stance. Take a look at how few stocks are actually above the 50% level, only these small histogram bars. The RSI indicator, again, is a very reactive indicator, so this shows us, this really reflects what has happened most recently. In contrast, every red dot here represents one stock in the S&P 500 as a percentage of its overall 52-week range. And we can see this is much more equally spread out. Obviously this takes a lot longer to react. So imagine if every stock had a trading range of $1 to $100 a share, you'd see quite an equal distribution. Here the histogram bars show us the frequency of the stocks at every respective 52-week range bracket, so to speak. So all the way on the left side here, we have 42 stocks that are trading at the 5 to 10% level of their own 52-week range. So again, if every stock traded in the 52-week range of $1 to $100 a share, you'd have 42 stocks here trading at $5 to $10 a share, right on the lows. If you take a look at this 50% level, most of the stocks are not trading above the 50% level. Most of the stocks are trading near the yearly lows for their own respective ranges. Here we see the top 10 sectors found in the S&P 500 denoted by the relative strength. The strongest sector, plastic products, paper, computer communications, paints, catalog supplies. Doesn't seem like there's any general or specific theme, I should say. If you take a look at the bottom 10 sectors in the S&P 500, home furnishings, oil services, real estate, hotel resorts, a lot of these names were found in last week's report as well. So it seems like there's more a significant or consistent theme in the sense that the weakest stocks, the weakest sectors seem to be, I think, more representative of the overall U.S. economy. Oil, real estate, hotels, that sort of thing. Construction also, construction equipment, I should say. Now, here we take a look at the change. On the left-hand side, we see the sectors that experienced the strongest change in terms of their own respective RSI. Which sector's relative strength went up the most this week? Well, we can see, and this is on a week-over-week basis, transportation services. This is what basically shows us what worked this week. Transportation services, metal fabrication, forest products, construction equipment, paper, things like that. Those sectors on the right-hand side experience the greatest amount of selling overall. Real estate, advertising, environmental services, oil, gas, transmission, mining. We see here precious metals as well. Again, you take a look at the mining, the oil, and the precious metals. That seems to have experienced the greatest amount of selling. That's where the money is moving out of. Now, on to the bond market. These are the current U.S. Treasuries. The 6-month bond right now pays a 4.61%. Now, if we were to go back several months, the 12-month bond paid the highest yield. But there has been a drop in yield across the board. We're going to see in a moment with only really the 6-month bond holding any kind of yield. Now, again, when yields go up, it means the bond prices are going down. When yields go down, the bond prices are going up. So we actually see bond prices are rallying in everything except for the 6-month, especially on the longer term. For example, here is the 1-month percentage change. This is a change in the yields of U.S. Treasuries. This is how much they've changed over the past month. And we can see that the 1-year yields have dropped 8%. The 2-year, 8%. The 3-year bond are on 5%. 5-year bond at 5% as well, roughly, a rounding here. But we see a massive drop. Now, that means that traders are actually buying these bonds. And that's why the yields are going down, because the bond market really has to offer, doesn't have to offer as much yield. But the 6-month bond really remains unchanged. Overall, the theme, as we've seen a lot of market volatility, a lot of, fear in terms of the banking sector, especially the smaller banks, as a result of the news recently. And also, you overlay that, we had, a couple days ago, we had the CPI and then the PPI, the inflationary numbers. So the PPI was not so hot. The CPI, excluding energy, is what we said, that seemed to be still quite strong. So I think the Federal Reserve is really caught in this, conundrum. We need to continue to raise rates to combat what seems to be rising inflation, except for energy. But at the same time, because of all the uncertainty in the banking sector, maybe the idea is, well, they should not raise rates so aggressively. As a result, traders are buying the bonds, the yields are going down. The bond market is telling us that the Federal Reserve is probably closer to the end of its interest rate hiking cycle. We know this just because the yields are going down. The bond market tends to move in anticipation of whatever the market thinks the Federal Reserve is going to do. Here is this month's change in the bond market, and we can see across the board. Take a look at all of these lines. All of a sudden, first week in March, we start to see a collapse in yield. The blue area chart, by the way, shows us the S&P 500. A collapse in yield across the board. Now, in particular, notice the lines that really kind of cross over one another. For example, we have the 1-year bond. This is this purple jagged line. Take a look how this crossed back below the 4-month bond, back below this purple line, the 3-month bond, back below the jagged white line, which is a 2-month bond. The 1-year bond yield, you literally collapse below the shorter term yields. And there really is an accentuation of the inverted yield curve. We see also the dark purple line here. That's the 5-year bond as well. Also aggressively going down. What's not going down so much? The 30-year. That's that white line. It's going down, but to a lesser extent. I think really the fastest move here, just visually, kind of trying to assess this, is the 1-year bond. Yields are just collapsing. Now, This is very important. In prior videos that we've put together, we take a look at the history of the inverted bond market. Please take a look at that particular video. The history of the inverted bond market shows us that in 2007 and 2000 and the year 2000 as well, around that time, we had an inverted bond yield, and the inverted bond yield ended when the 1 year crossed back below the 10-year. And we see here the 10-year is that the red line here? Yeah, the 10-year. So the purple line is still very much ahead of the 10-year, the red line, but this could be something that may soon happen. Now, this is exactly what we're talking about. The black line is a 10-year, the red line is a 1 year. The red histogram bars show us the amount of the inversion, how much the 1 year, the red is above the black line. But notice this histogram bar is starting to go up, meaning the 1 year is aggressively going down, much more than the 10-year. If and when we see this one cross back below the black line, then we could certainly see a change in the stock market to the downside. At least that's what happened in 2000 and 2007. Here's the 10 and 2. This is also a very common gauge. The black line is a 10-year bond. The red is a 2. We see the 2 is still above the black line. That's still an inverted bond yield. But if we see this 2 cross back below the black, that could be a catalyst, a change of something to come. So we're going to watch this very closely because it certainly is a very interesting turn of events, a real crush in the yields across the bond markets. This is much more exciting, in my opinion, than what's happening in stocks. But these two markets, really do move together over the long term. We hope this has been helpful. We look forward to seeing you back soon.